In this video, we're going to be following the research framework which I made specifically for these ETF review videos to review the HSBC Russia Capped UCITS ETF. We're going to be looking at the past performance of the ETF and the underlying index, the tracking error, the costs and liquidity, and the risks and the opportunities involved. Finally, we're going to be scoring the ETF on the set criteria so that we can compare it with other ETFs which we've reviewed on this channel, and to hopefully save you some time by just providing a sort of summary for the ETF. HSBC launched their very first ETFs back in 2009 and now have over 29 ETFs. They were actually the first company to provide a European ETF which tracks a Russian equity market. The ETF was created back in 2011 and tracks the MSCI Russian Capped Index. That is just a custom index where each of the individual constituents' weightings are limited to 30%. That's just to make sure that the fund doesn't concentrate too much on a single constituent and so diversifies across the whole of the holdings. This is actually super important for this index in particular because the index only tracks 24 companies. That means that if a single company just has a good few years in a row, they can easily become overweighted. So capping this at 30% just makes sure that the risk is spread. The index contains 8 energy companies, including those mammoth companies such as Gazprom and Lukoil. Since these 8 energy companies are so big, they command over 50% of the assets within the index. The index also contains 8 companies within the materials industry, including the gold miner Polyus and the nickel miner Nornickel. Materials account for about 20% of the funds in the index, with the rest spread across financials, consumer staples, utilities, and communications. So with such a heavy weighting towards the energy industry, the index and so the ETF is very reliant on what's happening within the energy industry and of course what's happening within Russia.
The past performance of the index and the ETF hasn't been great, to put it politely. If we look inside the ETF's fact sheet, we can see that the annualized return since inception is around negative 4.23% per year. Now, this isn't great, is it? But it's also slightly misleading. The data in the fact sheet is correct as of the 31st of March 2020. This is at the depth of the corona crisis, where we all know what happened to the price of oil and oil companies.
If we calculate the annualized return of the ETF as of the 30th of June, then we can see that the annualized return since the ETF was created back in 2011 is around minus 2.9% per year. Of course, this is still not good, but it's a lot better than the negative 4.23%, and this really highlights an important point, that annualized returns are largely dependent upon the dates that you choose to look at. Often analysts can be, let's say, selective about the dates that they choose and the time frame that they look at depending on the story that they want to tell.
In January 2016, the ETF hit a low of 407. By January 2020, it was trading at 1145, a 180% increase over 4 years, which works out as an annualized return of just over 29% per year.
Now, this is of course theoretical, as it's near damn impossible to time the market like this. But instead it just highlights a really important point, that the annualized return figures can't always be taken at face value, and sometimes you just need to dig a little deeper to understand the true picture there. The annualized return of the ETF, if you look at it since inception, is really poor. If you dig a little deeper, however, and look at select timeframes, then it's clear that there are some really large gains to be had. This though points to another problem, volatility. This is likely because the ETF only tracks 24 companies, and it's also very reliant on the energy industry, and in particular the oil industry. Despite the fact it's volatile, the tracking error of the ETF and the index actually isn't so bad. This is just a standard deviation between the returns of the index and the returns of the ETF. The larger the number, the worse it is, the bigger the difference between the two. It means that since 2011, the ETF has underperformed the benchmark, the index, by about 0.55% per year. This is just due to when the shares are purchased, how the shares are purchased, and the costs of the ETF. The costs of the ETF are fairly high at 0.6% per year. When we compare this to an ETF such as VUSA, the Vanguard ETF which tracks the S&P 500 in the US, then their tracking error is 0.07%. It's quite a large difference when you look at it like that. Russia, however, is classed as an emerging market, and ETFs which track emerging markets do tend to have higher expense ratios, just because the research costs there are much larger. A fairer comparison would be with the iShares MSCI Russia ETF with the ticker symbol ERUS, ERUS. Their expense ratio is 0.59% per year, and so when you compare the two, you can see that the expense ratios seem reasonable. The liquidity of the ETF is fairly weak, with just over $121 million in assets. When we compare this to the iShares ETF, the ERUS, we can see that they have 4 times the assets with just over $400 million. This just means that it can be quite hard to buy and sell the ETF in times of hardship. This is slightly concerning, to be honest. I made a video last week all about the United States Oil Fund and how investors lost money because of the way that the USO, the United States Oil Fund, invested their money in short-term oil futures. The reliance on short-term oil futures meant that investors couldn't rely on that ETF as a way to make the most of the rock bottom oil prices and to bank on the long-term recovery of oil. Instead, investors are looking at other ways to do this, one of which is by investing in the oil companies themselves. A comment on this video by Tony brought this ETF to my attention. With such heavy weightings towards the energy and the oil sector, and with absolute mammoth companies such as Lukoil and Gazprom, then this ETF is quite a good way of tracking the price of the energy commodities such as oil. As demand is now picking up and the price of oil is increasing, then I think this is the biggest opportunity for this ETF itself. As our countries continue to relax lockdowns and as our economies slowly start to pick back up, then demand for energy is increasing and this is pushing the oil price up. It's reasonable to assume that the price of oil, and specifically the price of the Russian Urals oil, will continue to increase towards its 2018 peak of about $82 per barrel. Currently it's at around $42 per barrel, and so we can see that there's still some way to go towards its peak, and I'm sure there's opportunity there for the savvy investor. This means that this ETF and the companies in which it holds shares in are well positioned to make the most of a rising oil price. With a dividend yield of 8.25% per year at the moment, then the ETF looks attractive to investors that are looking to grow the value of their investments, but also fixed income investors who are looking for larger dividend yields. It's not all good news though. The ETF looks like a good tool to make the most of rising oil prices and to diversify your portfolio into a country which you wouldn't usually diversify into, if I'm honest, Russia. But is oil and the energy sector really the best place for a long-term buy and hold investor? In my opinion, absolutely not. If you look inside the key investor document, you can see that the ETF is classified as risk level 7. You don't often see this. This is the highest rating of risk, and you shouldn't blindly ignore it when you do see it. The long-term prospects of oil is dubious at best, but compound this risk with investing in an emerging market like Russia, plus the risk of only having it diversified across 24 companies, plus the high volatility, the high expense ratio, plus the risk that you might not actually be able to buy and sell the investment because of the lower liquidity when times are hard, then it's really starting to paint a picture that is a risky investment. This ETF is, however, a UCITS ETF. That does give me some peace of mind knowing that the ETF has met certain criteria to protect investors like you and me from unsuitable and unsafe investment vehicles. This means that I'm not completely ruling the ETF out, it's just that I'd be cautious of holding any more than 10 to 15% of my portfolio in an ETF like this. Is it safer than investing in short-term futures contracts? Absolutely yes. But is it safer, or does it offer higher returns than investing in an index such as the S&P 500? Well, that's rather questionable. To score the ETF then, the past performance has been again very questionable. If you look at it from inception, then you wouldn't invest in the ETF, no way. Although I don't believe this paints a fair picture. If you dig a little deeper, it's clear that there were gains to be had. And I think this is helped largely by the high dividend yield. I think the ETF is well positioned to make the most of a rising oil price. For this, it scores a 5 out of 10. For the tracking error, it scores a 6 out of 10. It's only got 24 companies to track, like, come on, it's not that hard. But the ETF has an expense ratio on the higher side and it is very volatile. This means that the tracking error hasn't been as tight as it could have been. For the cost and liquidity, I mentioned about the expense ratio of 0.6% being on the high side, but for an ETF which tracks an emerging market, it isn't unreasonable. It's slightly high, but not unrealistic. The liquidity, however, is also a little on the thin side. When we compare this to alternatives such as the iShares ERUS ETF, we can see that the liquidity doesn't quite match up. And so for cost and liquidity, it scores a 4 out of 10. Finally, for the risks and the opportunities, it's actually more of the same. The short-term prospects of the ETF look great. It looks like it's well positioned to make the most of rising oil prices, and with a high dividend yield, this means that these gains are transferred directly into your pocket. Although naturally, this is a risky one, especially for those long-term investors. For that, it scores a 4 out of 10. Now, this scoring might actually seem a little harsh, but to me, it just reflects a rather balanced ETF, with a lot of give and take. I mean, the tracking error isn't the best, but it only tracks 24 companies, so it should be better. The costs aren't great, but it's an emerging market, so it's not too bad. It's very balanced, it's very give or take. This overall gives me the impression that the ETF is a little bit hit or miss. It certainly isn't right for everybody. In my opinion, the iShares ERUS ETF is a better investment, solely because the liquidity is better. There's no other reason. On every other metric, it's about the same, but it's just one less thing to worry about if it has strong liquidity. Even then, I would use the ETF as a way to realize short-term gains and to diversify my portfolio away from the traditional markets. I hope you liked the video. If you have any questions or if there's an ETF which you're interested in, leave a comment just like Tony did, and hopefully I'll make a video exploring it just like this one.